Welcome, discerning viewers, to a critical expose that could redefine your understanding of the American dream, especially if that dream involves the Lone Star State. For years, Texas has been the beacon of opportunity, a land of booming economies, affordable living, and endless growth. People flocked here in droves, seeking refuge from high-cost coastal cities, drawn by the promise of spacious homes and a vibrant job market. The narrative was simple. Texas is where you go to build a better life, where your investment in real estate would only ever climb. But what if that narrative is crumbling before our very eyes? What if the very foundation of this seemingly invincible real estate market is starting to crack, revealing a much darker, more unsettling truth? Today, we're pulling back the curtain on a phenomenon that many are whispering about, but few are truly ready to confront. The Texas housing bubble is not just deflating, it's bursting, and it's doing so with alarming speed in 2025. This isn't just a minor market correction. This is a seismic shift, a perfect storm of economic pressures converging to create an unprecedented crisis. We're talking about a scenario where the dream of homeownership is turning into a nightmare for many, where once thriving communities are teetering on the brink, and where the very fabric of Texas real estate is being rewoven into something unrecognizable. Are you prepared to witness which cities are silently transforming into ghost towns? Are you ready to face the stark reality that the Texas you thought you knew might be rapidly disappearing? In this groundbreaking revelatory video, we're not just scratching the surface. We're diving deep into the heart of the matter. We will meticulously unveil 10 Texas cities where property values are plummeting at an astonishing rate, where the exodus of residents has begun, and where once bustling neighborhoods are eerily emptying out. This isn't speculation. This is data-driven analysis, backed by the latest trends and expert insights. We'll show you the undeniable evidence, the cold, hard numbers that paint a grim picture of a market in distress. The surge in foreclosures, the exorbitant costs of insurance, record-high property taxes, and soaring inventory levels are not just isolated incidents. They are a coordinated assault, wreaking havoc across the entire Texas real estate landscape. From quaint small towns that once promised tranquility to sprawling suburbs that symbolized growth and prosperity, make no mistake, no city is immune in 2025. The illusion of perpetual growth has shattered, replaced by the harsh reality of rapid decline. The prices of homes, which skyrocketed to dizzying heights during the pandemic-fueled frenzy, are now free-falling, with some markets registering breathtaking drops of 15% to an astonishing 30%. Imagine the shock, the despair, the financial ruin for those who bought at the peak believing the hype, convinced that the only direction was up. But the pain doesn't stop there. The cost of simply owning a home in Texas has become an unbearable burden for many. While property values plummet, insurance premiums in Texas have simultaneously skyrocketed from approximately $2,000 per year to an astronomical $7,000 per year in some areas. This isn't just an increase. It's a financial chokehold, squeezing homeowners dry, making the prospect of staying in their homes increasingly untenable. This dual assault, falling values and soaring costs, is creating a perfect storm, pushing countless families to the brink. If you're contemplating buying a home, investing in real estate, or even considering a move to Texas in 2025, you absolutely must watch this video first. Your financial future could depend on it. We will equip you with the most current data, alarming trends, and expert analysis to empower you to make intelligent, informed decisions. This isn't just a warning, it's a crucial guide to navigating treacherous waters. Stay with us, because what you're about to discover will fundamentally change your perspective on the Texas real estate market. This video is for informational and entertainment purposes only, and does not constitute financial, legal, or real estate advice. Always do your own research and consult with a licensed professional before making any financial decisions. Like, comment, and subscribe for more in-depth analyses of the American real estate market. To truly grasp the magnitude of what's unfolding in Texas, we must first understand the confluence of factors that have led us to this precipice. This isn't a singular event. It's the culmination of years of unsustainable growth, speculative fervor, and a sudden, brutal collision with economic realities. Let's rewind a bit. During the pandemic, Texas became a magnet, Remote work policies allowed millions to escape congested high-tax states like California and New York, seeking more space, lower costs of living, and a perceived better quality of life. The influx was unprecedented. Demand for housing exploded, far outstripping supply. Builders couldn't keep up, and existing homes were snatched up in bidding wars, often for well over asking price, sometimes with cash offers waiving all contingencies. This created an artificial, hyper-inflated market where prices seemed to defy gravity. Everyone from first-time homebuyers to seasoned investors felt the FOMO, the fear of missing out, and jumped into the fray, often stretching their budgets to the absolute limit, convinced that property values would only continue their upward trajectory indefinitely. But the party couldn't last forever. The Federal Reserve's aggressive interest rate hikes, initiated to combat rampant inflation, acted like a cold shower on this overheated market. Mortgage rates, which had been historically low, suddenly soared, making homeownership significantly more expensive overnight. A monthly payment that was once manageable at 3% interest became an insurmountable burden at 7% or 8%. This immediately priced out a massive segment of potential buyers, leading to a dramatic drop in demand. Homes started sitting on the market longer, and sellers, who had grown accustomed to bidding wars, found themselves facing a stark new reality: price reductions. Adding fuel to this fire is the skyrocketing cost of home insurance. Texas, with its susceptibility to severe weather events, from devastating hurricanes along the coast to brutal hailstorms and tornadoes inland, not to mention the occasional winter freeze that cripples infrastructure, has always had higher insurance premiums than many other states. However, the past few years have seen an exponential increase. Insurers, facing billions in payouts from increasingly frequent and intense natural disasters, are either pulling out of the state entirely or dramatically hiking their rates to offset their risks. We're talking about premiums that have more than tripled in some areas, jumping from around $2,000 to over $7,000 annually. For a homeowner already grappling with higher mortgage payments and inflated property taxes, this additional burden can be the straw that breaks the camel's back. It's not just an inconvenience, it's a significant chunk of disposable income, forcing many to make impossible choices. And then there are the property taxes. Texas is one of the few states without a state income tax, which sounds appealing on the surface. However, this revenue gap is largely filled by some of the highest property taxes in the nation. As property values soared during the boom, so did the assessed values of homes, leading to astronomical property tax bills. Even as market values begin to decline, the assessed values often lag, meaning homeowners are still paying taxes based on inflated valuations from previous years. This creates a cruel paradox. Your home is worth less, but your tax bill is still sky high. This triple threat, high interest rates, exorbitant insurance premiums, and crushing property taxes, is creating an unsustainable financial environment for countless Texans. It's pushing homeowners into foreclosure, deterring new buyers, and ultimately, emptying out neighborhoods. The dream of Texas homeownership is rapidly becoming a financial trap for many, and the consequences are now manifesting in a way that is impossible to ignore. Now let's get to the heart of the matter. The abstract economic forces we've discussed are not just theoretical. They are having a very real, very devastating impact on specific communities across Texas. These aren't just numbers on a spreadsheet. These are homes, businesses, and lives being uprooted. The ghost town effect isn't just a dramatic phrase. It's becoming a stark reality for several once thriving Texas locales. We've meticulously analyzed market data, foreclosure rates, inventory levels, and population shifts to identify the cities most acutely affected by this bursting bubble. Prepare yourselves, because the picture we're about to paint is grim, and it serves as a powerful warning for anyone considering a move or investment in the state. Our first city on this unsettling list is Midland, Texas. For decades, Midland was the undisputed heart of the Permian Basin oil boom. Its economy was inextricably linked to the price of oil, and when oil was high, Midland boomed. People flocked there for high-paying jobs, and the housing market reflected that prosperity, with homes selling for premium prices. However, the volatility of the oil market, coupled with the broader economic downturn and the specific pressures we've outlined, has hit Midland exceptionally hard. The city's reliance on a single industry has proven to be its Achilles heel. As oil prices fluctuate and companies scale back, job opportunities dwindle, leading to a significant outflux of residents. Property values in Midland have seen some of the most dramatic declines in the state, with some estimates showing drops exceeding 25% from their peak. The inventory of homes for sale has swelled, and properties are sitting on the market for months, often requiring multiple price reductions before attracting any interest. Foreclosures are on the rise, and the once vibrant downtown area is showing signs of distress, with increasing vacancies in commercial properties. The energy that once defined Midland is slowly draining away, leaving behind a landscape of uncertainty and economic contraction. Next, we turn our attention to Killeen, Texas. Home to Fort Hood, one of the largest military bases in the world, Killeen's economy has always been heavily influenced by the military presence. While a stable military population can often buffer a housing market from extreme volatility, Killeen is now experiencing a perfect storm of its own. The rapid increase in interest rates has severely impacted affordability for military families, who often rely on VA loans. With rising costs of living, including those astronomical insurance premiums and property taxes, many military personnel and their families are finding it increasingly difficult to afford homes in Killeen, or are choosing to rent instead. This has led to a significant oversupply of housing, particularly in the rental market, which then spills over into the for-sale market. Property values have seen substantial corrections, with declines of 18–22% in many neighborhoods. The city is grappling with a high vacancy rate, both in residential and commercial properties, and the once steady stream of home buyers has slowed to a trickle. The transient nature of military life, combined with the current economic pressures, is accelerating Killeen's decline, transforming parts of it into a shadow of its former self. Our third city facing a grim future is Odessa, Texas. Much like its neighbor Midland, Odessa's fate is deeply intertwined with the oil and gas industry. When the energy sector thrives, Odessa thrives. But when it falters, the ripple effects are immediate and severe. The recent downturn in the energy market, exacerbated by global economic uncertainties and a push towards renewable energy, has dealt a heavy blow to Odessa's economy. Job losses have mounted, and the population, which swelled during previous oil booms, is now shrinking. This exodus of residents has left a glut of homes on the market, far exceeding the dwindling demand. Property values in Odessa have plummeted, with some areas experiencing drops of up to 30% from their peak. The city is witnessing a surge in foreclosures, and the once bustling streets are becoming noticeably quieter. Businesses that relied on the robust oil economy are struggling, and many have closed their doors permanently. The optimism that once permeated Odessa has been replaced by a palpable sense of apprehension as residents grapple with a rapidly deteriorating housing market and an uncertain economic future. These three cities serve as stark early indicators of the broader crisis unfolding across Texas, demonstrating how quickly prosperity can turn into peril when the economic foundations begin to crumble. The economic contagion isn't confined to the oil patches of West Texas or military towns. The ripple effects of the bursting housing bubble are spreading, reaching into diverse regions and impacting communities that once seemed impervious to such downturns. The factors we've discussed, the soaring interest rates, the crippling insurance premiums, the relentless property taxes, and the sheer oversupply of homes, are creating a perfect storm that is now engulfing even seemingly stable markets. The illusion of Texas exceptionalism, where real estate always goes up, is being shattered, revealing a vulnerability that many were unwilling to acknowledge. Let's continue our unsettling journey and uncover more cities that are silently, but rapidly, transforming. Our fourth city on this alarming list is College Station, Texas. Home to Texas A&M University, College Station has historically enjoyed a relatively stable housing market, buoyed by a constant influx of students, faculty, and university-related staff. The demand for housing, both rental and for sale, has traditionally been robust. However, even this seemingly resilient market is now feeling the squeeze. The rapid increase in interest rates has made homeownership less accessible for many, including young professionals and families associated with the university. Furthermore, The sheer volume of new construction that occurred during the boom years, anticipating continued growth, has now created an oversupply. Developers, eager to capitalize on the perceived endless demand, built extensively, and now many of these new homes are sitting vacant, struggling to find buyers. Property values in College Station have seen significant corrections, with declines in the 15–20% range in many areas. The rental market is also experiencing increased vacancies, putting downward pressure on rents and further impacting property owners. The once predictable rhythm of the university town is being disrupted by economic anxieties, and the future stability of its housing market is now very much in question. The usual seasonal fluctuations are being overshadowed by a more fundamental shift, leaving many to wonder if the student-driven economy can truly withstand these broader market forces. Moving eastward, our fifth city in distress is Beaumont, Texas. Situated near the Gulf Coast, Beaumont's economy is heavily reliant on the petrochemical industry and port activity. While these sectors provide a base of employment, Beaumont is particularly vulnerable to two major factors: the escalating cost of insurance and the increasing frequency and intensity of hurricanes. As we've highlighted, insurance premiums along the Texas coast have become astronomically high, making homeownership prohibitively expensive for many residents. The constant threat of hurricanes and the subsequent damage and rebuilding costs deter new buyers and investors, while existing homeowners face the daunting prospect of ever-increasing premiums and deductibles. Property values in Beaumont have been stagnant or declining for several years, but the current market conditions are accelerating this trend, with drops of 10 to 15% becoming more common. The city is grappling with an aging housing stock, limited new development, and a slow but steady population decline as residents seek more affordable and less risky areas. The combination of economic pressures, environmental risks, and the prohibitive cost of insurance is creating a challenging environment for Beaumont's housing market, pushing it further into a state of decline and making it a prime candidate for the ghost town effect. Finally, for this block, we turn to Waco, Texas. Once a city that garnered national attention for its revitalization efforts and a burgeoning tourism industry, Waco is now facing its own set of real estate challenges. While it doesn't have the direct oil dependence of Midland or Odessa, or the extreme coastal insurance issues of Beaumont, Waco's housing market was significantly impacted by the pandemic-era boom and the subsequent interest rate hikes. Many investors, drawn by the city's growing popularity and relatively lower home prices compared to major metros, bought properties with the expectation of quick appreciation or robust rental income. However, the sudden shift in market dynamics has left many of these investors underwater or struggling to find tenants at profitable rates. Property values, which saw a rapid ascent, are now experiencing a sharp correction, with declines in the 12–18% range. The inventory of homes for sale has increased, and properties are taking longer to sell. The enthusiasm that once characterized Waco's real estate scene is waning, replaced by a cautious skepticism. The city's economic base, while diversified, is not immune to the broader statewide and national trends, and its housing market is now reflecting the widespread distress, proving that even cities with positive national PR can't escape the gravity of a bursting bubble. It's a common misconception that major metropolitan areas, with their diverse economies and larger populations, are somehow insulated from the kind of housing market turmoil we're describing. Many believe that cities like Dallas, Houston, Austin, and San Antonio are too big to fail, too robust to experience the ghost town effect. But this couldn't be further from the truth. While the core of these megacities might show more resilience, the sprawling suburbs and exurbs that grew exponentially during the boom years are now facing immense pressure. The very factors that drove their growth, affordability, space, and the promise of a short commute to a thriving job market, are now being undermined by the current economic climate. The contagion is spreading, and it's reaching deep into the heart of Texas's most populous regions. Our seventh city on this critical list is Conroe, Texas, a rapidly growing suburb north of Houston. Conroe experienced an explosive population boom over the past decade, driven by its proximity to Houston, relatively lower home prices, and the allure of a more suburban lifestyle. Developers poured money into new communities, building thousands of homes to meet the insatiable demand. However, the rapid increase in interest rates has dramatically cooled this red-hot market. Many potential buyers, who once saw Conroe as an affordable alternative to Houston, are now priced out due to higher mortgage payments. The sheer volume of new construction, which was once a sign of prosperity, has now become a liability. There's a significant oversupply of homes, both new and existing, leading to a glut in inventory. Property values in Conroe have seen substantial corrections, with declines in the 15–20% range in many of its newer developments. Foreclosures are ticking up, and homes are sitting on the market for extended periods, often requiring multiple price cuts. The once bustling construction sites are slowing down, and the dream of rapid appreciation has evaporated, leaving many homeowners and investors in a precarious position. Conroe serves as a stark reminder that even the most dynamic suburban growth stories can quickly unravel when market fundamentals shift. Next, we turn our attention to Denton, Texas, a vibrant university town situated north of Dallas and Fort Worth. Denton, like College Station, benefits from a strong university presence, but it also experienced immense growth as a desirable suburb within the Dallas-Fort Worth metroplex. Its unique blend of small-town charm and big city access made it a magnet for families and young professionals. However, the same forces impacting other Texas markets are now taking their toll here. The rapid escalation of home prices during the pandemic, coupled with the subsequent surge in interest rates, has made homeownership increasingly unaffordable for many. The inventory of homes for sale has risen significantly, and properties are taking much longer to sell. Property values in Denton have seen corrections in the 10–15% range, and the market is showing signs of further softening. The once robust demand, fueled by both university growth and metroplex expansion, has significantly diminished. The local economy, while diversified, is not immune to the broader economic headwinds, and the housing market is now reflecting a cautious, if not outright pessimistic sentiment among buyers and sellers. Denton's experience highlights that even desirable, growing communities within major metro areas are not immune to the broader market downturn. Our ninth city on this sobering list is New Braunfels, Texas, a popular destination known for its German heritage, scenic rivers, and proximity to both San Antonio and Austin. New Braunfels has been one of the fastest-growing cities in Texas for years, attracting retirees, families, and tourists alike. Its appeal as a recreational hub and a more affordable alternative to Austin fueled a massive housing boom. However, this rapid growth has now collided with the harsh realities of the current market. The sheer volume of new construction, particularly in master-planned communities, has created an oversupply that the current demand simply cannot absorb. Interest rate hikes have priced out many potential buyers, and the once frenzied pace of sales has ground to a halt. Property values in New Braunfels have seen significant corrections, with declines in the 12–18% range, especially in newer developments. The city is experiencing an increase in inventory, and homes are sitting on the market for extended periods. The tourism industry, while still strong, cannot fully offset the downturn in the housing market. New Braunfels, once a symbol of Texas's booming growth, is now a prime example of how quickly an overheated market can cool, leaving behind a trail of unsold homes and uncertain futures. The dream of a quiet, picturesque life in this charming city is becoming increasingly expensive and for many unattainable. The bursting of a housing bubble isn't just about declining property values or rising foreclosures. Its impact reverberates far beyond the real estate market itself, creating a cascading effect that can cripple local economies and fundamentally alter the social fabric of communities. When homes lose value, homeowners lose equity, which means less disposable income for other purchases. When people are forced to sell at a loss or face foreclosure, their financial stability is shattered, impacting their ability to spend, invest, and contribute to the local economy. This creates a vicious cycle, where a struggling housing market leads to a struggling local economy, which in turn further exacerbates the housing crisis. The ghost town effect isn't just about empty houses. It's about empty stores, empty schools, and a palpable sense of despair. Consider the impact on local businesses. When residents leave, or when those who remain have less money to spend, small businesses, the lifeblood of any community, are the first to suffer. Restaurants see fewer diners, retail stores experience declining sales, and service providers find their client base shrinking. This leads to business closures, job losses, and a further erosion of the local tax base. As businesses shutter, the vibrancy of a town diminishes, making it even less attractive to potential new residents or investors. We're already seeing this unfold in many of the cities we've discussed, with once thriving commercial strips now dotted with "for lease" signs and vacant storefronts. The entrepreneurial spirit that once defined these Texas towns is being stifled by economic hardship. Then there's the strain on public services. Property taxes are a primary source of funding for local governments, schools, and infrastructure projects. As property values decline, so too does the tax revenue. This forces difficult choices: cut essential services, lay off public employees, or raise tax rates on an already struggling populace, a move that often accelerates the exodus. Schools, which rely heavily on property taxes, may face budget cuts, leading to larger class sizes, fewer resources, and a decline in educational quality. This, in turn, makes the community less appealing to families, further contributing to population decline. The quality of roads, parks, and other public amenities can also suffer, creating a downward spiral that is incredibly difficult to reverse. And let's not forget the psychological toll. The dream of homeownership is deeply ingrained in the American psyche. For many, their home is their largest asset, their nest egg, and a symbol of their hard work and stability. To see that asset rapidly depreciate, to face the prospect of foreclosure, or to be trapped in a home that is worth less than what is owed on it, is emotionally devastating. It breeds uncertainty, anxiety, and a loss of faith in the future. This emotional distress can lead to broader social issues, impacting mental health, family stability, and community cohesion. The ghost town effect is not just about physical emptiness. It's about the erosion of hope and the fracturing of communities. Finally, our 10th city on this list, representing the broader suburban spillover, is Frisco, Texas. Once the poster child for rapid affluent growth in the Dallas-Fort Worth metroplex, Frisco symbolized the peak of the Texas real estate boom. With its gleaming new developments, top-tier schools, and corporate relocations, it seemed unstoppable. However, even Frisco is now experiencing a significant slowdown. The sheer volume of high-end homes built, coupled with the dramatic increase in interest rates, has created an oversupply in the luxury and upper-middle-class segments. While not seeing the same percentage drops as some of the smaller towns, Frisco's market has shifted from hyper-competitive to buyer-friendly, with homes sitting longer and price reductions becoming common. The once guaranteed appreciation is gone, replaced by stagnation or slight declines. The cost of living, including those soaring property taxes and insurance premiums, is making even affluent areas like Frisco less attractive, especially for those who bought at the peak. While not a ghost town in the traditional sense, the slowdown in Frisco is a powerful indicator that even the most robust and desirable markets in Texas are feeling the profound effects of this bursting bubble, demonstrating that no corner of the state is truly immune to the economic forces at play. So, what does all of this mean for you? If you're a current homeowner in Texas, a prospective buyer, an investor, or someone considering a move to the Lone Star State, understanding these dynamics is not just important, it's absolutely critical. The landscape has fundamentally shifted, and the strategies that worked during the boom years are now fraught with peril. This isn't a time for speculation or wishful thinking. It's a time for informed decisions, careful planning, and above all, caution. For current homeowners in Texas, especially in the affected areas, it's crucial to assess your financial position. Understand your equity or lack thereof. If you're considering selling, be prepared for a longer market time and potentially significant price reductions. Refinancing might be an option if rates drop, but for now, focus on managing your property taxes and those escalating insurance premiums. Explore all avenues for property tax appeals and shop around aggressively for insurance. If you're struggling with mortgage payments, reach out to your lender immediately to discuss options before foreclosure becomes a reality. Ignoring the problem will only make it worse. This is a time to be proactive and realistic about your home's current market value. For prospective homebuyers, this market presents both risks and potential opportunities. The days of bidding wars and waiving contingencies are largely over. You now have more leverage. However, don't jump in blindly. Do your due diligence meticulously. Research specific neighborhoods and cities, looking beyond the headlines to local market data. Pay close attention to inventory levels, average days on market, and recent price reductions. Factor in the total cost of ownership, including those high property taxes and insurance premiums, which can add hundreds, if not thousands, to your monthly expenses. Don't overextend yourself, even if prices seem to be coming down. A falling knife can still cut deep. Consider waiting if you can, as further price corrections are likely in many areas. And absolutely, secure a pre-approval for your mortgage to understand your true buying power in this high-interest rate environment. For real estate investors, the Texas market is now a minefield, but also potentially a hunting ground for distressed assets. However, extreme caution is advised. The buy low, sell high mantra is tempting, but identifying the true bottom of this market is incredibly difficult. Foreclosures will likely increase, presenting opportunities, but also significant risks. Understand the local rental market dynamics. Are vacancies rising? Are rents declining? Factor in the soaring costs of property management, maintenance, insurance, and taxes. This is not a market for amateur investors. It requires deep market knowledge, significant capital, and a high tolerance for risk. Focus on cash flow and long-term viability, rather than quick appreciation, which is unlikely in the near future. And for anyone considering moving to Texas in 2025, this video should serve as a stark warning. The narrative of endless opportunity and affordable living is being severely challenged. While Texas still offers many advantages, the real estate market is no longer the guaranteed win it once was. Research your target city thoroughly. Understand its economic drivers, its vulnerability to natural disasters, and the true cost of homeownership beyond the sticker price. Renting for a year or two before buying might be a prudent strategy to better understand the local market dynamics and allow for further price corrections. Don't let the allure of a lower purchase price blind you to the hidden costs and potential risks. The Texas housing bubble is indeed bursting, and its effects are profound and far-reaching. From the oil towns of West Texas to the sprawling suburbs of the major metros, no region is truly immune. The dream of Texas homeownership, once a beacon of prosperity, is now fraught with peril for many. But with knowledge comes power. By understanding the forces at play, by doing your research, and by consulting with licensed professionals, financial advisors, real estate agents, and insurance brokers, you can navigate these treacherous waters more safely. This is a time for vigilance, for prudence, and for making decisions based on data, not on past glories or speculative hopes. The future of Texas real estate is uncertain, but your financial future doesn't have to be. Stay informed, stay cautious, and stay prepared. If you found this analysis insightful, please give us a thumbs up, share your thoughts and questions in the comments below, and don't forget to subscribe and hit the notification bell so you don't miss our next deep dive into the evolving American real estate landscape. Your engagement helps us bring you more critical information like this. Thank you for watching.